Are whole life insurance annuities a scam? Kinda in one word, yes. Also a little bit of no and a little bit of maybe. Good morning and welcome to the Steve and Carlson Show. Of course, it may not exactly be morning when you're watching this. It's very morning for me. It is 5:27 a.m. on a Saturday morning. Yeah, I know, I'm one of those weird people that really likes mornings. Anyways, like I was saying, this is the Steve and Carlson Show. I'm Steve Carlson. I'm sure you've heard it all before. Wall Street is like a casino, and only wealthy people make money. Normal people like us, we just get slaughtered. The problem with this mindset throughout the past 100 years is every significant drop in the stock market has been fully recovered all of its losses within 5 years. So as long as your investment strategy is for longer than 5 years, you can make an average of 7% annually. More importantly, who is the person that's giving you this advice, that's telling you to stay out of stocks and instead purchase a life insurance annuity policy? Are they your life insurance broker? What ulterior motives, if any, do they have? Are they just trying to sell you on this safe investment strategy just so they can make a hefty sales commission? If you listen to their sales pitch, it sounds amazing with guaranteed payments for life no matter what happens in that risky stock market. On the surface, this sounds great. But once you dig into the numbers, you will quickly see how bad of a deal annuities are for most people. Of course, there are a few unique situations where annuities may be helpful, such as parents providing for special needs children that will require special medical attention for the remainder of their life. So people in unique situations like that, it may be useful to have an annuity. But for the rest, it's probably a bad idea, and I'll explain why. But first, I need you to please smash that like button and subscribe to the channel. Doing so helps so much with the YouTube algorithm. Also, I'd love to hear from you if you already have an annuity, so comment down below. If you're unfamiliar with this whole life insurance annuity concept, the basic idea is you give an insurance company your money, and in return they pay you a small income stream for the rest of your life. In some annuities, if you die before you received all of your money back, well, kind of sucks to be you. The insurance company keeps all the rest of the money. I'm not making this up. That's how many policies work. Of course, this is not always the case, and there are plenty of annuities that will pay your family members back a continuing benefit throughout the rest of their life. It just depends on the terms of your policy. Of course, terms like this usually cost more money. The stupid thing about annuities is they're sold to you on fear of the stock market and how it's such a gamble. Yet, in reality, you're basically making a gambling bet yourself. You're betting the insurance company that you're going to live longer than what they think you will live. During your lifetime, they will take your money, invest it in the stock market themselves, and give you a very small portion of the profit they make off of your investment. Yes, you heard me right. They take your money, they invest it, they give you a small percentage, and they keep all the profit themselves. Of course, they are guaranteeing you a specific rate of return every single year. So if the stock market has a bad year, you still get paid. Like for example, how fears of the coronavirus dropped all the major indices nearly 13% in 3 days, but the insurance companies know that statistically, while there may be a bad year or two, over your entire lifespan, the market always goes up. The insurance companies will profit, and they know it. In fact, annuities are such a terrible investment that just after the US government passed a law in 2016, specifically stating that financial professionals had to act in their clients' best interest, sales of annuities fell 8%. They slid an additional 18% the first quarter of 2017 and have been continuing to fall ever since. A $500,000 benefit policy with your broker usually makes them between 2 to 7% of the total fee up front. So in this case, your broker may have just made $35,000 to convince you to sign on the dotted line. Sounds like a little bit of conflict of interest to me. So how exactly do these annuities work? In the most basic form, you pay your monthly premium to your insurance company, for example, say $500 per month. Part of that is allocated to the cost of providing you insurance, and part of it is allocated to your cash value account. This is where insurance company invests part of your money tax deferred. The cash value account pays you a dividend about 4 to 6% per year. The purpose of the cash value account is to offset the cost of providing you insurance as you get older without changing the monthly premium costs you are required to pay each month. How about we break down these numbers with a little example? Let me introduce you to two sisters, Suzy and Stephanie. Like most siblings, they sometimes are best of friends and other times they are at each other's throats. This is one of those times where the sisters just cannot agree on anything. They each want to get a life insurance policy with a $500,000 death benefit, but they cannot agree which one to get, term or whole life. Suzy decides to purchase a whole life insurance annuity and pays approximately $563 per month. Part of her monthly goes towards her cash value, and she expects to get paid a dividend of 5.5% per year. Not bad, right? Well, the problem is you're not exactly paid 5.5% on the whole $563 per month that you paid, only on the cash value part. Based upon a recent study, the average annuity paid out closer to 2% of the total premium. 30 years later, Suzy would have paid approximately $202,680 in premiums. But her cash value of the account would be more than $250,000. So she made like 50 grand, right? Well, let's take a look at her sister Stephanie. Once again, she has a life insurance policy with a death benefit of $500,000. But her policy was a 30-year term, and her monthly premium is about $52 per month. After 30 years, Stephanie has only paid $18,720 towards her insurance. Of course, the 30-year term is up, so she gets nothing. Kind of sounds like a crappy deal, right? Suzy must be better off. Heck, she actually made money, didn't she? Not exactly, and here is why. Stephanie was a little bit smarter than her sister Suzy, and she invested the difference between her life insurance policy cost and that of her sister's annuity policy. In this case, that was about $511 per month that she invested back into a fund that tracks the S&P, which averages about 7% per year. Now her investment is worth $580,000, but her sister's only $250,000. That's a 2 times better return. But that's only part of the story. Remember how I said the cash value investments are tax deferred? That is a fancy way of saying you're not paying the taxes now, but when you pay them when you retire, oh boy, will you pay them. The crappy part of annuities is they are taxed as ordinary income, not long-term capital gains like any other normally held stock investment that you have held for 30 plus years. Additionally, if you invest that $511 per month in a Roth IRA, all of your investment is now tax-free. Check out my video on Roth IRA investments. The link is in the description below. So in summary, a whole life insurance annuity policy, is it a scam or a bad idea? Well, for most people, especially those in their 20s, 30s, or 40s, yes, it's most likely a waste of money. You'd be far better served investing in a wide-ranging index fund that follows the S&P. There you will average slightly better than 7% per year, even when calculating inflation, as long as you invest for greater than 10 years. Of course, if you're a little bit older or have a unique health situation, an annuity may be right for you, but you will need to carefully consider all the options to determine if it is right for you or not. So what should you do if you're already in a poor performing annuity term? Well, obviously I'm not a lawyer, I'm not a certified financial advisor, so I cannot provide you any advice, but I would still suggest that you sit down with somebody that you trust and see what your options are. Sadly, you most likely are stuck in a bad deal, as many of these policies have full termination clauses that will penalize you 15 to 25%. Plus, keep in mind, this was tax deferred, so there's also going to be large tax ramifications as well. On top of having to pay your taxes now, there's probably also a 10% early termination fee that you'll have to pay as part of your taxes as well for removing money out of your investment account too early. I really hope you like this video. Please like and subscribe. Comment down below. Tell me your story if you have an annuity, or if you had a friend that had one, family member, whatever. Let me know. Comment. See you next week.